Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon and I'm joined by Alistair Ross. Alistair, Greece appears to have a deal. Does that mean that the crisis in Greece is anywhere near a resolution?
Resolution wouldn't be the word. Clearly, they've pushed the issue on another step, a very important step. Greece was at the very, very brink of default, and that would have been quite catastrophic for the Eurozone and potentially for the world economy. That has been avoided, but of course, these were very, very tough negotiations. Everybody has had to move, everybody's had to give something up. The highest price probably is going to be paid by the Greeks themselves. And I don't think there's many people out there who think that this is the final round of this particular crisis. It will push things off a little further, but Greece will be back, I think, for more help. I mean, this has reduced its overall debt, the expectation of its overall debt levels to 120% of GDP by 2020. And that's an extraordinary amount of money for any country to deal with, particularly a country that doesn't have the ability to generate high foreign exchange revenues such as Greece. So I don't think by any means this represents anything like the end of Greece's problems or the end of Europe's problems. What it perhaps does is begin to build this very important firewall between Greece and the rest of the Eurozone. So maybe other countries in the Eurozone, some of the other weaker peripheral countries, can breathe a little bit of a sigh of relief. The pressure isn't going to be on them immediately. And as we've seen elsewhere in Eurozone policy making, this injection of fairly cheap funds into the banking system by the ECB at the end of last year has had a tremendous impact on confidence and on sentiment around the Eurozone. And that's brought down the cost of borrowing for Spain and Italy, for example, which is hugely important for them. That's not to say that there aren't still fractures and weaknesses in the Eurozone. There are. You know, we look at Portugal now, its borrowing costs are sky high. And if the pressure wasn't on Greece and the attention wasn't on Greece, there's no question that people would be focusing on Portugal as another line of weakness.
And turning to the United States, how is the crisis, do you think, in the Eurozone impacting on the US? I mean, you upgraded your forecast for the US in the recent past. Do you see yourself upgrading it again?
Well, again, the impact was largely indirect, and it was one of sentiment. So if things had gone badly wrong in the Eurozone, or indeed if things do go badly wrong in the Eurozone, the impact on the US would be substantial. The financial linkages between the two regions are very strong. The fact that the pressure is now off in the immediate term in the Eurozone is helpful to the United States, without a doubt. But the key drivers of our forecast for the United States are more domestic than that. I mean, what we've seen over the last few months in the US is something of a renaissance, an economic renaissance after some very difficult times last year. The consumer, on the one hand, through expanding consumer credit, is supporting growth in the US economy. Manufacturers, on the other, through rebuilding inventories that were run down last year, is also supporting growth. So what we saw, for example, in the fourth quarter of 2011 was pretty strong growth of 2.8% in the US economy. And that's very encouraging. As you said, we upgraded our forecast for the US quite substantially last month to 1.8% for the year as a whole. We're not going to upgrade again for the moment. These are positive signs. Most importantly of all, they demonstrate a trend, very slow but a recovering trend. It's going to take a long time, but at least it's on in the right direction. But it is a very modest recovery, and the risks confronting the US have certainly not disappeared. So it's not time yet for us to upgrade again. So we'll be sticking with our forecast there of 1.8%.
Now, at the present time, there's a lot of concern about the situation vis-à-vis Iran and the US and the potential for instability, even war in that region, and also the impact that could have on the oil price. So just give your analysis of how you see things panning out with regards to Iran just in the short term.
Well, Iran is, there are many risks confronting the global economy, but without a doubt, the number one immediate concern is the situation in Iran, where we have this long brewing confrontation, this long brewing face-off between the West on the one hand and Iran on the other in its nuclear ambitions. That is coming to a head. Clearly something is going to have to give. Iran is getting closer and closer to that point of no return, where actually it can declare itself capable of weaponizing its nuclear capability. And at that point, the whole calculation changes. So all of the pressure is to do something before that point arrives, and we may be fairly close to that point now. And that's why things are bubbling so much now and coming to a head. The problem, of course, is that there's only so much that the West can do. There are only so many instruments the West has at its disposal to confront Iran, particularly when you consider that there are world powers, Russia and China, that don't agree with the approach that's being taken by the Western powers. So I think that we will see a strong racking up of tensions. Measures will certainly be taken with increasing intensity over the coming weeks. But as I say, it's important that there's only to recognise there's only so much that the Western powers can do. I mean, I think the threat by Europe to stop to embargo Iranian imports of Iranian oil is a good example. It's like me telling you I'm going to punch you and then asking you to stand still for a while I go and get my boxing gloves. You know, we can't stop buying the oil straight away. And in the meantime, Iran can retaliate by saying, OK, well, we're going to stop exporting to you then. So,
and you touched there on the price of oil. I mean, generally speaking, what's happening in the commodities sector?
Well, it's very interesting. It's quite a contrasting picture. On the one hand, you have the risk premium that's coming on to the oil price, mainly as a result of the situation in Iran and the threat to flows through the Strait of Hormuz. And as a result of that, for example, we've increased our forecast for the oil price this year, the Brent crude price, from $100 a barrel to $110 a barrel. And that's a 10% increase, more or less, quite a strong increase. A lot of the price increase is already coming through. I mean, prices right now are $120, $125 a barrel. And this, compared to where they were a few months ago, is already having a significant impact on sentiment around the world. If things did come to a head in Iran and supplies were severely disrupted, and it was impossible, for example, very quickly to replace those supplies with imports from other regions, you would see a big spike in oil prices, maybe $150 a barrel, maybe more, and that would have an immediate direct impact on the global picture. On the other hand, there are other trends in the commodities market that are acting in the opposite direction. Our forecast, for example, this year for industrial raw materials in general is for a decline in prices of around 13%. And that's, you know, major component of the costs of companies all over the world that we expect to go down. So to some extent, you have this offsetting trend in commodities prices, largely driven by demand factors because we expect slowing growth in the emerging world and in the developed world. Overall, a big spike in oil prices is going to hurt, and ultimately lower prices for industrial raw materials are going to compensate a little, but certainly not fully.
Well, Alistair, there's no shortage of issues we could touch on, but time's against us. So for more analysis of world events, join us again next month on the Global Forecast. But until then, thank you for watching and goodbye.